Assalamu alaikum and a very good day to Prof. Dr. Nur Adli Ridwan Shah bin Muhaddali. I'm one AMIRUL, and as your student analyst for the Money and Capital Market course, MFA 3023, I'm absolutely thrilled to present this explainer of my evaluation on Frontken Corporation Berhad. Today, our main objective is to dive deep into Frontken and rigorously evaluate whether it stands as an attractive Sharia-compliant investment within the Malaysian capital market.
To do that, here is our roadmap for today's analysis. We'll quickly cover an introduction to Sharia compliance, dig into the background of Frontken, look at the specific investment instrument, break down the technical analysis, run through the performance and valuation metrics, and finally wrap it all up with a solid conclusion. Let's jump right into Section 1, Introduction to Sharia-Compliant Equities. So Sharia-compliant investments are a huge deal in the Malaysian capital market. Basically, these are financial instruments that have been meticulously reviewed and cleared by the Sharia Advisory Council, or SAC, over at the Securities Commission of Malaysia. What this means is that all business activities are strictly in line with Islamic principles, allowing investors to generate profit without compromising their beliefs. For this assignment, we're zoning in on equity, specifically Frontken Corporation Berhad, which trades on the main market of Bursa Malaysia under the stock code 0128. Moving right along to Section 2, let's look at the background of Frontken Corporation. Founded back in 1996, Frontken isn't just your run-of-the-mill tech company. They're a highly specialized service provider focused on precision cleaning and surface treatment for premium engineering parts. Now, while they do serve the oil and gas, electronics, and power generation sectors, their bread and butter, their absolute core focus, is the semiconductor industry. They essentially increase the lifespan and performance of components used in semiconductor manufacturing, which, as you know, requires highly controlled, low-contamination environments. They operate across Malaysia, Singapore, the Philippines, and Taiwan. And actually, Taiwan's role here is incredibly crucial. As a massive global semiconductor manufacturing hub, Taiwan brings in the largest chunk of the group's revenue, embedding Frontken deeply into the global supply chain. This global footprint really shows up in their FY 2025 financial highlights. Frontken pulled in a revenue of RM 607.8 million. That's a solid 7% increase, and a net profit of RM 154.2 million, which is an awesome 13% year-on-year jump. Backed by a net cash balance of RM 833 million and its official recognition as a Sharia-compliant security, Frontken is perfectly positioned to ride some massive global megatrends. We're talking the explosive expansion of AI, cloud computing, and overall digitization. Okay, Section 3. Let's talk about the specific investment instrument we're looking at today. We are analyzing Frontken's ordinary shares. As equity instruments, ordinary shares give you a slice of ownership and a share in the company's success. Now, we chose ordinary shares because they offer two ways to make money: capital appreciation and dividend income. But as we'll see, Frontken is really an equity play for capital appreciation, meaning you're betting on the share price itself going up. Yes, they did pay a dividend of 2.0 sen per share for FY 2025, but the real attraction here is their massive growth potential in the tech sector. But as an analyst, I have to give it to you straight. Investing in Frontken equities isn't risk-free. The stock price will bounce around based on market sentiment and sector dynamics. Specifically, an investor faces four main risks here. First, sudden fluctuations in global semiconductor demand. Second, rapid technological changes that could potentially leave Frontken behind. Third, foreign exchange rate volatility, since they have multinational operations. And fourth, just general global economic uncertainty. You've always got to carefully weigh these risks against the potential returns. Up next is Section 4, Share Price Behavior and Technical Analysis. For our technical analysis, we locked in on a 50 trading day observation period from April 1st to June 15th, 2026. The price action here was super dynamic. The stock initiated the period at RM 380 and concluded at RM 497, dipping to a low of RM 373 and reaching a high of RM 499 along the way. But here is the number you really need to care about: 30.79. Going from RM 380 to RM 497 represents a phenomenal total percentage return of roughly 30.79% in just 50 trading days. The average closing price across that whole window was RM 4.48. This is a very clear, undeniable signal of a strong, bullish trend in the market. Let's trace how that bullish trend played out chronologically. In early April, we saw a consolidation phase. The price was trading in a tight band between RM 380 and RM 402. You could tell investors were quietly accumulating shares. Then, by mid-April, boom, we got a definitive breakout past the psychological RM 400 mark. Now, there were some brief corrections in early June, but renewed buying interest quickly sparked a robust recovery. Seeing those consistent higher highs and higher lows over the 50 days is textbook stuff. It proves investor confidence was surging, fueled entirely by the market's optimism around AI and cloud computing. Digging into the technical levels, our initial support floor was pretty solid between RM 370 and RM 380. After that breakout, a brand new higher support zone firmly established itself around RM 460 to RM 470. On the flip side, we spotted a resistance ceiling hovering right between RM 5RO and RM 510. If the price breaks above that, it's a huge signal that the bullish run is continuing. Also, the simple moving average, or SMA, totally backs up this positive outlook because the short-term average is consistently riding higher than the long-term one. Finally, looking at volatility, we calculated an average daily return of 0.57% alongside a standard deviation of 1.85%. What this means is it has a moderate, highly favorable volatility profile. It's hitting that sweet spot, an optimal balance between manageable risk and rewarding returns. All right, let's move into the core of it with Section 5, Performance and Valuation. Here is our high-level overview comparing 4 vital financial ratios across FY 2024 and FY 2025. As we walk through every single one of these metrics separately, a really clear narrative is going to emerge. You'll see a company that's actively optimizing itself for massive future expansion, rather than just focusing on short-term payouts. Let's start with return on equity, or ROE. At first glance, seeing ROE drop from 18.99% in FY 2024 down to 14.89% in FY 2025 might make you pause. But actually, scratch that. It's not reflective of poor performance at all. Remember, Frontken's net profit actually went up to RM 154.2 million. The ratio only decreased because the denominator, shareholders' equity, ballooned to 1.04 billion. Basically, Frontken is aggressively retaining its earnings to reinvest and expand its operational capacity for future growth. Next up is the price to earnings, or PE ratio, which jumped from around 39 times up to a whopping 49.22 times in FY 2025. You know, a high PE doesn't necessarily indicate financial weakness or an overvalued trap. In this context, that high multiple is solid proof that investors are more than willing to pay a premium for Frontken shares. Why? Because of its irreplaceable role in the semiconductor supply chain. The market is already pricing in the massive expected earnings growth tied to AI, cloud computing, and semiconductor expansion.
Looking at dividend yield, we see a reduction from 0.53% down to 0.40% in FY 2025. Again, context is key here. The actual absolute cash dividend paid stayed exactly constant at 2.0 cents per share. The yield percentage only dropped because the share price shot through the roof over the year. This mathematically proves Frontken's growth strategy. They are a reinvestment-focused stock. They prioritize business development over handing out big chunks of income as dividends. So this stock is tailored for long-term capital appreciation, not necessarily for dividend-seeking income investors.
And that brings us to what is literally the most staggering metric on the board, the debt-to-equity ratio. For FY 2025, this figure came in at an exceptionally low 0.0001. That is almost zero. It highlights an incredibly conservative capital structure. Frontken relies almost entirely on shareholders' equity to fund its activities, with virtually zero external debt. The advantage of this cannot be overstated. It means minimal financial risk and total protection against the pressures of rising global interest rates. Synthesizing all of this for our overall assessment, Frontken's future performance is fundamentally rock solid. Macroeconomic factors like positive GDP growth and stable interest rates create a fantastic environment for investment. And on the micro and sector levels, the sheer unstoppable momentum of global digitalization, data centers, cloud computing, and above all, artificial intelligence practically guarantees sustained long-term demand for semiconductors, and by extension, Frontken's precision services. They are perfectly positioned. Finally, Section 6, Conclusion. Let's get to the investment verdict. To summarize, Frontken Corporation Berhad was selected because of its robust competitive positioning and its vital, Sharia-compliant role in a booming tech sector. From a technical standpoint, we saw a stellar 30.79% return over just 50 days. Fundamentally, they boast an ironclad balance sheet, highlighted by that near-zero debt-to-equity ratio of 0.00001. Because of its intense focus on reinvestment, Frontken is absolutely the right play for growth investors who want long-term capital appreciation rather than dividend income. Therefore, my overall investment recommendation is that Frontken represents a highly attractive, Sharia-compliant long-term investment. As the world races toward an AI-driven future, the real question isn't whether the semiconductor industry will grow, but rather, can any investor afford to be left out of its foundational supply chain? Professor Dr. Nuradli, thank you for watching.